Do you want to get going with dividend investing, but only want to invest, let's say, $1,000? No problem. I'll show you how.
Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. We've got to start our equities dividend investing career somewhere, and as you might have guessed from this title, that somewhere is $1,000. I've said $1,000 because it's a nice round number. I'm from the UK, so £1,000 would be good too. It's not about the exact figure or currency. The point is, it's something, but it's a much smaller amount than we one day hope to have invested.
$1 million.
By the way, this video is not about what makes a good dividend stock. You can find that in my last video, logically titled, What Makes a Good Dividend Stock. This video is about how to make a dividend stock portfolio. A dividend portfolio is a collection of dividend paying stocks that together aim to be well diversified and give you the best chance of earning consistently high dividend payouts. It's fine to own stocks for reasons other than the dividend, they just won't form a part of the dividend portfolio we are creating here. Now, I have some money to invest in dividend stocks. Where do I even start? You start with your goals for the portfolio.
Having a dividend portfolio allows you to earn, if successful, some passive income and generate wealth for the long term. But which one of those are you prioritizing? Do you want to invest in companies who make monthly dividend payments? You can do that by owning a portfolio of stocks that have dividend payment dates every month.
A simple example, if you have 12 stocks in your portfolio, you can make sure that each stock pays its dividend on a different month. So if you had 52 stocks in the portfolio, you could get paid weekly. You get the point. We can take this a step further with weighting. No, not Arnie style weighting. I mean, we can buy different amounts of each stock. The way we weight it can be adjusted for the size of the dividend yield, for example.
Say we have 3 stocks. Stock A pays a dividend of $20 in February, stock B pays $30 in March, and stock C pays $40 in April. If we wanted to even out the monthly payout, one way would be to buy more of stock A and less of stock C.
The more popular use of dividend portfolios is as a long-term growth asset, reinvesting the dividends you receive and increasing the value of your portfolio and growing your wealth over the long term. In this instance, you will attach more importance to the size of the dividends versus the timing when you are looking for income. Let's move things along to what I think would have been one of the first questions on your mind. How many stocks should I have in my portfolio? When it comes to deciding how many stocks you should have in your portfolio, the best answer is KISS. Keep it simple, stupid.
With $1,000, we can have, for example, 10 stocks with an average of $100 invested in each. You might think 10 stocks is not enough, but actually you can have a lot of variety in size of company and risk profile among 10 stocks. And there's even 11 major sectors, so it means you can come close to covering all parts of the stock market.
I hear the smarty pants saying, well, if it's 11 sectors, you're going to miss one. But keep in mind, $1,000 is our starting point. We want to add to this portfolio with deposits and dividend reinvestments over time to get it to where we need to be. So instead we can have a simple allocation of $100 per stock for the portfolio. But what if one or more of the stocks you want to buy is priced over $100? This is one of the main challenges of starting a portfolio with only $1,000. For some of the biggest companies, take Warren Buffett's Berkshire Hathaway as an extreme example. At the time of filming this video, the stock price just ticked over $500,000.
Clearly one of those shares, let alone 9 others, are too pricey for our portfolio.
But, drumroll please, thanks to fractional shares, what I've just said is a fractional share is less than one whole share. Owning fractional shares allows you to buy less than one share of a company. Let's say you want to invest $100 into Tesla stock, but each share is worth $1,000. You can buy 0.1 of a share for $100. For the purposes of building our $1,000 portfolio, fractional shares will be invaluable. To illustrate how fractional shares can work for our portfolio, here's an example of 5 stocks. Apple, one share is $165. Microsoft, one share is $279. Visa, one share is $211. McDonald's, one share is $252. Johnson & Johnson, one share is $181. Buying a single share of these 5 companies would cost $1,088 using fractional shares. We can reduce that to less than $500, leaving room for our next 5 shares. So in each of these cases, we can chop down the price. Apple, we can make $99. Microsoft, we can make $83.70. Visa, $105.50. McDonald's, we can chop to $100.80. And Johnson & Johnson, we could make $90.50. Using fractional shares, the cost of this portfolio is now $479.50. Easy, right? Well, with the Trading 212 app, it's actually even easier. Instead of selecting the number of shares or the fraction of the shares we would have, you can select the amount you would want to invest, and the app automatically calculates how many fractions of shares that will be. If I pull up the app and choose J&J, for example, I click buy, you can see the default is number of shares. Just click that and switch to value. And in my app, my deposit currency is euros, so you can see that even the exact amount of any currency that you want to invest is choosable. Using fractional shares will allow you to not only fit the portfolio within your budget by investing specific amounts, but fractional shares give you the ability to invest in more companies over a wide range of countries and industries. Sweet diversification. Balance is important in investing. Making sure that your portfolio isn't overly reliant on one particular stock or industry is key to making your portfolio durable. Our portfolio will have 10 stocks, so that removes a lot of the individual stock risk. Spreading your risk over multiple sectors of the economy will ensure industry risk is reduced too. This is a list of the 11 major economic sectors: information technology, healthcare, financials, consumer discretionary, communication services, industrial, consumer staples, energy, utilities, real estate, and materials. Finding one company in each is the ideal way to protect our portfolio against adverse economic conditions. The logic is that when one sector may be struggling, another sector might be thriving in exactly the same conditions. Of course, there are a lot more ways to distinguish companies than the sector that they're part of, and actually, two companies within the same sector can be very different. A simple way to diversify risk within a dividend portfolio is to choose stocks with different size of dividend yields. Yield correlates well to risk, and the higher the yield on the stock, the higher the risk. Flooding your portfolio with high yield stocks means flooding it with risk. On the flip side, a portfolio of very low yield stocks is going to have less than impressive returns.
For example, you can choose to create a base of reliable stocks where the yields are on the lower side, and then top them off over time with small allocations to some higher yield stocks.
Before I round out this video, there's one last powerful trick I have up my sleeve to get our $1,000 dividend portfolio off to its best start. I do think that 10 stocks is plenty of diversification. You only need to look at Warren Buffett's Berkshire Hathaway to see that actually the top 10 stocks make up the bulk of the money invested. But one way we can supercharge the diversification of our portfolio is by adding an index ETF or an index fund. An exchange traded fund or ETF is a basket of stocks that trade on an exchange just as if it were a single stock. It's a great way of investing in multiple different stocks at once and automatically is diversifying your portfolio. If you are mostly investing in American companies, you might opt for an ETF based on the S&P 500. If you're investing in the UK, it might be the FTSE 100, or in Europe, the Euro Stoxx 600. So I hope at this point you've got some ideas on how to get that first $1,000 invested to start earning some dividends. But what next? Put simply, growing it.
With the help of a good investing app like Trading 212, you can automate the reinvestment process in case you want to reinvest any proceeds from your investment, which happens to be what I just spoke about in my previous video.
But enough about me and my videos. This is your chance to share what stocks you'd put in your $1,000 portfolio by dropping a comment below. Tell us about the stocks. And if you like this video, please make sure to smash the like button, subscribe, and hit the bell icon so that you see more videos like these as soon as they're released. Thank you very much for watching, and happy investing.